Good morning, good afternoon, good evening, wherever you're located on Earth. It's time for a pre-market post-wave report with yours truly, the Algo Capitalist, aka the Vulcan, coming to you live from postwavetrading.com, home of the world famous post-wave price trigger reports. Want to say what's up to my Aussies out there? How y'all living? Um, I've been of course, I stay in the lab. You know this. So let's do this. We're going to do a few things. Last night, as you know, I was running behind schedule. I was doing a few things. Had to make some updates to the algos. As you know, it takes an enormous amount of work, to keep the algos popping, to keep you guys on the right side of these markets, help you lock in your profits with the pop method. And I'm always looking for opportunities and ways to improve. So I have made some updates because of the global algo shift. I've made a few what's the word I'm looking for? Cosmetic changes. Uh, Most of it will be unnoticeable to you that subscribe to the post wave reports. But the one part that will stand out though to you is I've added some things because the way that I do the reports, space is limited, so I can only put the most pertinent information on there. So what I had to do was I squoze in some additional things, and I will go over that in another video for our post wave subscribers. I'm going to show you what was added. Nothing was changed, just something was just added, and I think it's going to give you some further insight into what's happening in the markets. I think you're going to really find it very helpful. And after all, that is the goal, right? To help you make money. You got to make that money. All right, so last night I did a rush job. I didn't really get a chance to do the end of day report like I like to. So we're gonna do that. We're gonna look at some charts. And then I want to go over what I'm looking at this morning. Then I'm gonna have to do a uh, a trade journal also later on. But right now I'm looking at the reports, and for those that subscribe to the Post Wave reports, you'll notice that our inverse ETF tickers, if you see a small letter Z and a dash in front of the name of the inverse ETF, what that signifies is those are the ETFs that I personally like to trade. As you guys know, who've been with me for years, you know that I abhor the 3x ETFs with a passion. I like the single leverage ones or the 2x. All right, I like those because their price action is a lot smoother, and even though equities are prone to gaps, their gaps are not so common as the 3x ETFs are. So I'm looking at the report, and what I like to do is I try to find, if I'm going to be trading equities, I want to find securities that have a primary rally alert. All right. That means I get to get in on the beginning of a new trend in the market. So I'm looking for that. I'm always looking for that. And I'm looking for secondary rally alerts and tertiary rally alerts because those are the three primary alerts when you're buying securities that you're looking for. Now, pretty much any day that the report has a buy trigger price under the daily price column, you're looking to buy the security that day, pretty much. All right. If the intraday price inflection points or hit, then you'll go ahead and you'll buy that security. Whether it be we're looking to buy dips or we're looking to buy rallies, doesn't matter. If that intraday price inflection point is hit, then we're in. So I'm looking today to try. I'm looking at the inverse ETFs, and I'll tell you why I'm looking at them. The reason I like like I said, the single inverse ETFs, not the 3x ETFs, is because they track with the underlinings a lot smoother. And oftentimes, when there may not be a clear signal in, like, let's say, the stock indexes, these inverse ETFs may tell an altogether different story. And it can be quite interesting. Like, for instance, looking at the NASDAQ 100 this morning, if you look on your report, you'll notice that it is in a bull market. All right, the position of it is a bull market, and it seems to be hitting some new weekly highs, right? So that's telling me that the pullback that you've been seeing in the NASDAQ is real. All right. Second thing I'm looking at is the inverse ETF for the S&P 500, and it matches that of the NASDAQ 100. I'm looking at the QUID as the inverse ETF for the NASDAQ 100, and the SDS for the inverse ETF for the S&P 500. So just off the rip, those match. Then you want to go and you want to take a look at the bond inverse ETF, and primarily I'm talking about TBT, which is the long bond inverse ETF, very famous security. And it's also coinciding with the S&P 500 and the bonds being in a bullish position. All right, so let's break this down. If your inverse ETFs are giving you buy signals and they're in a bull market position, that means that you can expect the underlining, because these inverse ETFs are basically derivatives of their counterparts. It means you can expect the market to continue to decline. So according to the inverse ETFs here, we can expect bonds to continue to fall in price with the stock indexes. Now, as you know, theoretically, this is not supposed to happen. It's a no-no. The bond market should not be falling with the stock market. Because if people are having a risk-off mentality, it means that money is now outflowing from stocks into bonds, because bonds is a flight to safety. All right. So risk on, risk off. All right. When you're risk off, you're going to go ahead and you're going to put your money in bonds where it's safe. Risk on, you're going to go ahead and you're going to jump into those equities. So this is very telling when you look at the algo charts, which the Pulsewave reports that you see on your dashboard are a result of that. It's very telling to what's going on. The Russell, my hustle though, inverse ETF, which is the ticker TWM, another widely held security, it's showing something different. It's giving me a primary crash alert showing this one to be in a bear market position, which means you can expect the Russell, which is the underlying security that the TWM is based on, that will be ticker IWM for the long Russell, is they're saying that the Russell is going to keep going, which is really interesting because as we speak, the Russell is up slightly. So this is a mixed market review, but we're not done yet. We cannot forget about the granddaddy of them all, the Dow. All right, so the Dow inverse ETF, ticker DXD, is showing a bull market also, with new weekly highs being approached. So if all of the indices except the Russell is showing this. As you know, the stock indexes move together. All right. They always move together. There are times in history past where there was a divergence. And in that case, it was the NASDAQ 100. It diverged while the other indices were hitting new all-time highs on the futures contracts in 2007. The NASDAQ barely even budged. Okay. Now, the reason why this is significant is because the Russell My Hustle tends to be a leader among the indices. Now, it is true that at times one of the indices may take a leadership position. Primarily, you have your Dow, Russell, and your NASDAQ. The S&P 500 really doesn't lead because it basically is the son of the Dow. So the S&P and the Dow are going to pretty much move tick for tick with each other, regardless of what the other indexes are doing. So with that being said, when we take a look at the SDS and the QUID and the TBT and the DXD, they're all in a bullish position on the algo charts with buy recommendations on them. Okay, so we know that the pullback is real, but the outlier, which is the Russell Inverse ETF, is given a primary crash alert with being in a bearish position, which is saying that the Russell is going to remain at strength here. Now, I will admit that there are times, okay, where you'll get a primary rally alert that the market decides, you know what, I changed my mind. I don't want to move in this direction. And so you may or may not get any downside production today. And the market will reverse course. So we could make an argument that the Russell is not necessarily leading the market, but maybe slowful to turn. And the stock indexes are kind of hung up right now, moving in a sideways pattern, waiting for their little brother Russell to catch up. That happens too. Now, if that does turn out to be true, then the inverse ETF TWM would be the primary play because it just started to fall. The Russell just started to fall. So you want, the Russell has further to fall to catch up with the other indices. So you would want to, pretty much go all in on that Russell to start off if you have a primary rally alert. So just looking at these inverse ETFs this morning are painting a picture. They're letting you know what's really going on in these markets. Now, gold has been breaking out too. And we're about to get to that in just a second. I'm looking at this Russell. Okay, so the Russell, the inverse ETF on the Russell has been bullish since March the 30th. And it's only just now today saying, okay, I've topped out and I'm ready to pull back. So we'll see. If we don't get any downside production today, though, that means that the bulls are coming in and they're buying, they're they have a put mentality. Instead of going into the options markets and buying a put, they are looking to buy the inverse ETF. As you know, I abhor options. I only use options when I absolutely must, or if there is a market condition that is so overwhelmingly delicious, I have no choice but to take a bite. But other than that, I rather trade straight equities, straight futures contracts, straight Forex, straight crypto, no options. I don't like when I have little to no control. And when you trade options, unfortunately, you have little to no control. It's a lot more complicated. All right. So you got to think about these things as you move forward, which, of course, I do. Another thing you want to get in the habit of doing, too, when you're putting your trades on, You don't want to ever overtrade or revenge trade. And you definitely want to make sure you've calculated your risk of ruin, which is what I put into great length and detail into these reports. I want to know, first and foremost, what my risk is and what my probabilities are. So I pretty much program that into the system. My 20 plus years, going on almost 30 really now, of so 28 years to be precise. These past 28 years for me, I have been putting all of my observations and experience into these reports. So everything that I have gathered and gleaned over the years, you are now benefiting from in the reports. I've done all the heavy lifting, all the hard work. I've taken away the steep learning curve and all that for you. So you don't have to, second guess or be uncomfortable when you get your reports. And I do realize that for some people, it does take time to learn to trust something. I get it. We all been there. But the reason why I do what I do is because I am so convinced that once you do finally get with the program, pun intended, that you will be extremely rewarded and very happy that you finally did. All right, so we're talking about gold a few minutes ago. And looking at the gold futures, I'll go ahead and pull up my screen. I know it's microscopic looking, but at least you can at least see what I'm looking at. And I have no way to make it any bigger than what it is. But these are the tickers here, okay? If you look at the crude oil, we'll start off with that one. Okay, so right now we're in the May contract on the futures. Current price is $102.40 a barrel. The overnight high was $102.89 a barrel, and it actually dropped to $99.88 a barrel. All right. Now, on your dashboard, on your reports, you will see a buy signal for the crude oil futures, but there's a caveat. What you need to do if you use Thinkorswim, look at the contract. That May contract is going off the board in a few days. So I went ahead and rolled to the June contract. So I did go ahead and I put in a buy based on last night's Pulsewave report entries. So I'm going to see if the market will pull back enough to get me in. I don't want to chase it, but because this is a primary rally alert for the oil, I also refuse to be left behind. So what I'm doing, I have my limit order working. But if it looks like that's not going to happen, then if this thing starts to run, I'm just going to jump in because the price isn't so far removed. And it's a primary rally alert, and we're already getting upside production. So I have no problem with that. And as a matter of fact, now that we're talking, I'm going to go ahead and do it right now. I'm going to, while I'm talking to you, I'm looking at the market. I'm going to go ahead and I'm going to hedge my bets here on the oil. We got 3 minutes into the opening bell, so let's go in here. There's the opening bell right there. All right, so I said 3 minutes. It was 3 seconds. All right, so June contract. Matter of fact, I'll share my screen just for a second with you, just so you can see what I'm doing and how I'm doing it. Let's see here. All right. So this is my Thinkorswim, just the trading platform. All right, so here is the future. So I'm going to come over here. I'm going to place my order right now. And if the market just runs and doesn't pull back to get me in at my price that I want, I'll take the run price instead. So let's see here. Let me see. Where was my stop on this one? Okay. We go in. All right. And we're going to go ahead and we're going to make this a good till cancel order as well. As you know, I'm in love with the micro contracts. That's all I trade is the micro contracts. Don't care much for anything else. All right. So there we go. We're set. All right. So I just placed the buy order there. As you can see here, I did it in the June contract. You can always go over here, you go and you check your orders. You can make sure you did the right contract. It gives you the ticker and then it gives you the expiration. So you know you're in the right month. Okay. And as you can see here, I did I added another one. I added a stock. It's going to be on the next report. The ticker is GLDG. It had as a primary rally alert on it. So I went ahead and put that in as well. Okay. So I wanted you to see that. All right. What else? Yep. As you know, I got the corn, soybeans, wheat. Twitter's on here. And we still got the short NASDAQ, the short Ethereum, short Bitcoin, and the short Russell still in play. If anything changes, I will update you on that. All right, so that's the shopping list. Those are the open positions or whatnot that we have. Of course, we just put that in now. Now I'm going to go to something else real quick. I'm gonna make up for last night. So just give me a second. We're going to get this on and popping because there's some things I want you to see. All right. So let's change this here, change that there. And now we can go in. Okay. So the opening bell for the New York Stock Exchange just hit. It's 9:30 Eastern Standard New York time. And right now you got some green on the screen. I'll let you see that real quick while I'm booting up my charts. All right. So Bitcoin futures is up 520. Ethereum's up 47.5. Crude oil right now is at 102.62. Nat gas up 15. Gold is up $6.70, trading at $1,982.80 an ounce. Silver is up 19 cents at $25.92 an ounce. Dow futures up 38. NASDAQ futures down 10.5. The E-mini S&P 500 is up 1.25. Russell My Hustle's up 13.7, but still trading under that 2,000 psychological resistance zone. Bonds are up 16.30 seconds at 142 and 29.30 seconds. TLT up 23 cents at 123.20. And TBT, we just finished talking about that, is off 7 cents. And of course, the grains, they're still playing games. They won't let you trade wheat futures, not even the micro contract, only closing orders only, which I think is a knucklehead move, but that's okay because I went in and I bought WEAT, I bought CORN, and I bought SOYB. Soybeans are down 3 points today at 1666. Still beans in the teens. Corn is down 3 at 773 a bushel. And of course, wheat is off 2 3/4 points at 1101 per bushel. So that's what we're looking at right now. Now it's time to switch our focus. I'm going to show you the algo charts from last night just to give you an idea of what's going on here and what you can expect today to happen. All right, so here we go. The first one, the first chart here, I've been hearing talk about lithium. So this is our precious metals, natural rare earth metals and things of that nature playlist, if you will. So this is lithium. The ticker is LIT. And notice how on the daily algo chart here, market dropped below Kumo cloud. and gave us a primary rally alert for today. All right, now in the background, I'm hearing trades go off. So let's see what I just got filled in. Okay, I don't know. That's a good question. What did I get filled in? Let's see what happened here. I'm already short, long. Oh, okay. The GLDG just went off. Okay, I knew it was something. GLDG intraday price inflection point just triggered. So got a long position there now. I knew it was one of those. Okay. So back to where we were. All right. So primary rally alert on the LIT Lithium. Looks like the market's trying to put in a bottom. You did gap down. Let me make this bigger. See that gap down from the prior day's open. This right here is what we did yesterday, creating that. But you're right below the Kumo cloud, so that's going to act as a resistance point. So it's yet to be seen if we're going to get any upside production or not. And you got this gap here that the market's going to have to come down and reconcile at some point. So we'll see. We will see. All right. Next one is I want you to see the Silver Miners ETF. The ticker is SIL. And it's funny because that's the same ticker for the micro silver futures contract. It's SIL/SIL on your Thinkorswim platform. All right, so you can see overall the market is consolidated with a upward bias. You got the bullish pointer from March the 8th, and it looks like a continuation pattern for today in the silver ETF, the silver miner ETF SIL. All right, next up, you got SLV, which is the silver ETF. It's a derivative of the futures contract, and the bears are still keeping this one kind of at bay. You got an increase in upward momentum here, and it's probably primarily to maybe some bears losing interest and saying, "Look, I've been short from March the 8th, and I'm done. I want to go ahead and just take my money off the table because it's already gotten back up to the initial primary rally alert from March the 9th. So if anything, I think there's some liquidation. I don't think there's any really bullish buying of this as of yet. We'll have to see how the market behaves today. But you have put in a temporary bottom. The market's no longer under a distribution phase and looks to be accumulating now. So maybe this is real. Maybe the SLV will get some increased upward momentum today. As we speak, you got silver was up slightly. Yeah, it's up 17 cents. So we'll see. And the SLV right now is up 23 cents. So already got a little bit of buying coming in, but we'll see. So yeah, we'll see about that. All right, next up is uranium. People have been talking about uranium, UEC. All right, so you can see this one's in the green, so you're in a bullish pattern, and you have a continuation bar here. So we're expecting this market to continue to run. Why it's running, I have no idea. Just because people want it to run, they're buying it. So I don't care about the whys. I just care about the price. So price action is saying that this is a real run. So long until it's not. Next up is the XME, which is the S&P metals and mining ETF. And you can see it's also sideways consolidated like SLV. And I think we're about to probably get a buy signal. This one also has come back to the initial crash alert from March the 28th. And the market's just been consolidating here. So we'll see what this one can do. Next up is the gold futures. And the gold futures, as you can see here, overall is also still in a bear market. All right, now it's up in the right now. Let's see what is up now. All right, it's up. Oh, okay. $7. All right, so at 1983, so already an increase in upward momentum. It looks like the market is out of the distribution phase, so we got that short-term bottom in there. This is a bearish pointer though, and this has you see more bears liquidating on the gold futures, which is probably helping that market to rise the way it is. You're at 1983, so yeah, I think the more and more bears get out, may have the bulls smell some blood in the water and want to come in here and bid this up. This could be a longer term bottoming pattern, but this bearish pointer still needs to be rectified at some point. So we'll see how the market handles that. Next up is the silver futures. All right, so this is the silver futures. These are all daily charts, by the way. As you can see here, this one also has come back to the initial crash alert from March the 9th. And you also have a nasty, nasty bearish pointer on March the 29th that has not been taken out. So at some point, I think the market's going to come down and test or take that out. And the fact that you're kind of dangling here like this is a little problematic. I think you could fall right out of this Kumo cloud quite easily. So I would definitely follow the reports on these. Don't try to be a hero and second guess the market. Just trade and follow the reports. The next one is copper. This ticker is COPX, the copper ETF. And you see copper had a nice run off the bear market lows. And it seems we have now put in a short-term top here in this one. And the market is under the distribution phase. You're in the red zone. Bears have control of this. You're consolidated, but you maintain a bearish bias in this particular market. All right, next up is the GDX. So the gold miners has been on an explosive move. Nice rally here. Can't say anything negative about this rally. This is a quality rally. It's a quality rally. It is what it is. So what I'm thinking here is that this will continue. I think what's happening is, remember that the mining stocks are a hybrid society, meaning that they can catch a bid off of a bullish metals price. Whatever they mine, they can be bid from that and catch benefits from that, the rise in that. But they can also suffer a drop if the commodity starts to fall in price. Then other times the stock can diverge from what's happening in the metals because it's also a stock. So mining stocks are, like I said, they're that a hybrid. They're the black-eyed children of the equities market, only because they can rise and fall with the commodity, and they can also diverge from it because of equity dynamics. So if they have good earnings or some other positive econometric modeling, fundamental forecast, what have you, it can cause the stock to rally even if the underlining is falling. So that's what you see happening here. You see the GDX is still in a bullish position, so we expect this one to continue to run. Next up is the Gdxj, the junior gold miners, and you can see they've had a nice trajectory too, keeping track with the GDX. And we do have a bullish pointer here from March the 8th in both of these. And I think that's where we're on tap to test and or take out. So I do see prices remaining to go higher here. Looking at GLD, which tracks the gold futures price pretty well. And you can see it here for yourself. GLD has not yet gotten back up. Oh, I'll take that back. It has. It's gotten back up to the March the 9th crash alert as well. This is a bullish pointer. It's not a major one, but it is a bullish pointer. I think the market's going to try to get back up and test. If it doesn't take it out, it's going to at least test it. So once again, I would not try to second guess. I would just follow the reports and do what the report tells you to do. Last and but not least is our is 10. I'm not 10. I mean nickel, because that's been in the news because of the war. And as you can see here, you have this bullish pointer from March the 7th. The market did give back a whole lot. Now it's consolidating with a bullish bias, albeit it's still under the trend line resistance, and it's under the Kumo cloud, and it seems that you have increasing selling pressure, all right, or liquidation of longs, which can cause a reverberation on the bearish argument side of this one. So that's what I want to show you guys. So now you see what I have been seeing in these metals and what we can expect. It's not a whole lot of fireworks. I know people have been sounding the alarms. Oh, the metals are back, and no, not necessarily just yet. I would hold your horses on that one. Don't get too happy. Don't get too excited. Just follow the reports. You will never feel sorry if you follow the reports, follow the system, do the discipline, put your stops in, use the pop method, lock in profit when you can. If you can, seek to take profits on a daily basis with the exception of equities. Can't do that in equities without getting hit with that pattern day trade rule, which is nuts. But with futures, forex, and crypto, you can take profits on a daily basis if you see like the old rule of thumb. You see anywhere from $250 to $350 profit on a position you put on that you've held overnight. You don't have to feel bad in taking those profits off the table. You can take profits off the table every day. You can do that every day and get back in the market when the market opens, and keep doing that every day. Keep putting money in your account every day. Now, the old school would say, no, you might as well just stay in a position if you're going to do that. But remember, there's a difference between paper profits and realized profits. Paper profits are unrealized profits. It's not profits until you actually take it. Once you take it, it's a plus positive in your account. And then when you put on your next trade, you're now officially trading with the house's money, not yours. All right. Until you book that profit, you are still trading with your principal and not, I repeat, not your profits. All right. So always remember that. Please do not forget that. Okay. Always remember that. All right. Now we're going to do the crypto segment. That was our precious metal segment. Now we're going to do the Bitcoin. All right. So Bitcoin is our first one, and you can see here it's looking pretty weak despite the little pops and stuff. You're just in the beginning phases according to the algo chart. This looks like the beginning of the down leg. We haven't even seen the down leg yet. You got a bearish pointer from February the 24th, and then you got another one from January the 24th. Let's look at this for a minute, folks. You can't make this stuff up. All right, now this is the Bitcoin futures chart. So gaps on this chart are real. When you see gaps, when I'm looking at the cash markets, those gaps you can ignore because they're not real. That's an algo thing, the way that I do my calculations and do things for the cash market. It's not the same as the futures. Okay, just FYI. You can't make this up. This bearish pointer was done on January the 24th of this year. Then we did it again on February the 24th, 1 month to the day. February 24th, January 24th. That's a rare occurrence to do the same thing the exact same way on the exact same day. That is beyond coincidence. Too many variables to make that happen like that. Those are two real bearish pointers. Now, this one was the market coming down, looking like it was going to test and take this one out from here, but it didn't. It just made you another one. This is the first stop. So the first stop is that means the market needs to drop below 34,295, and we're at 39,000 now. That's 5,000 Bitcoin Satoshis lost that looks like the market is about to give you. Then the second target, it has to drop even more. All right, so here you're dropping below 34,295. Here you have to drop below 32,855. 34,295, 32,855. So yeah, we have thousands of points that the market is staring into the abyss about. All right, so you're staring at the abyss right now in the Bitcoin. So remember, the futures is very important. Believe it or not, the futures is now leading the cash market. Please do not forget that. I didn't make it up. I didn't design it. All right. I told you back in 2016 in those 2 documentaries I didn't do it for my health. I did it to warn you guys. I told you in 2016 that the governments of the world were coming and they were going to co-opt the whole crypto space and make their own blockchain. And in the meantime, they were going to disrupt the already existing crypto space. And how did they do that? With money. Federal Reserve, central banks come in and on the low, start operating in the space. That's right. All the epic crashes and insane rallies you've ever seen in any market is always due to the central banks. Don't you ever get that twisted. All right. So they are in this space. They have their reasons. They know what they're doing. Trust and believe when I say this, it's happening. Hedge funds are now in the crypto space operating. That's why they made these futures contracts, because it's harder for them to do what they do and use their little insider trading edges in the cash market. They need derivative markets to do it. That's why the E-mini S&P 500 was created back in 1997. That's why you had your the Bitcoin futures now in existence, and now they got the micro contracts. Just remember, they kept the public, the retail trader, they kept the retail spec out of the Bitcoin futures market for years. All right. It was only now that they allow the retail spec to participate in the Bitcoin futures. That's why they made the micro contract. So just something for you to remember, FYI. So this does not look bullish at all. This hurts the bullish sentiment that people have been saying all over social media. This is increasing selling pressure into the Bitcoin future space. Next up, we're going to look at the Bitcoin Cash, not Bitcoin Cash, but the cash market of Bitcoin. That's what I mean when I say that. All right, let me just give me a second. Let me pull it up. It's around here somewhere, and I will find it with all these charts. Then again, maybe I didn't pull it up. We'll come back to that. Okay, here is the Ethereum. Oh, wrong one. Here's the Ethereum Futures. Also very pertinent, very important. And look, what do you have here? You can't make this stuff up, people. January the 24th, February the 24th. How else do you explain that? When they say one thing that happens, oh, that's a coincidence. But when you see it twice, now it's a pattern. This is Ethereum futures, not Bitcoin. Howbeit, same date, same bearish pointers, same as Bitcoin. Same date, same type of environment. That's because large institutional money is flowing into the same markets at the same time. That's why they created these bots and high frequency trading and all that stuff. That's why these big hedge funds hire, doctorate degree physicists and mathematicians from MIT, all right, to write their code and program their computers, all right, so they can do things like this. But see, the algo capitalists got you covered. You don't need a doctorate from MIT in computer science or physics or advanced computer programming. You don't need any of that. You got the algo capitalists, man. Our algos are superior to their algos. If not, how is it possible for us to be as consistently profitable as we are if that were not true? Do you think the elite want retail specs operating in their space, making money? No, they want you to be fodder for their profits, okay? Not all of these large funds are profitable. You should know that too. One of the reasons why they have such a hard time is because we exist. As long as there are pulse waves on this planet, it will continue to disrupt the elite's plans. So your Ethereum is looking like your Bitcoin, but there's a difference. Your Bitcoin is not as bearish. I'm sorry, the Ethereum futures is not as bearish as your Bitcoin futures. It is bearish. We're getting all this nice downside production from the initial crash alert from April the 5th. But look what's happening. Your price is still above the Kumo cloud. All right. Unlike Bitcoin, where you're already all up into the cloud, your Ethereum has further to fall. So if the markets have decided they're going to come down and test and take out these bearish pointers, that means Ethereum has further to run down. So a good short would be this Ethereum based on that alone. So just something to think about as we move into the trading session today. Your ADA Cardano is looking like this. So yesterday, or should I say last night, the market gave us a possible primary rally alert, looking like the market wants to put in a bottom here. But you got the overhead trend line resistance in your way, and you're still in the Kumo cloud, and you got this increasing selling pressure. If we don't see any upside production today, chances are the market wants to come down and take out this bearish pointer from February the 24th. This is another market now. This is the third market. Once is a coincidence. Twice is a pattern. The third time is enemy action. Ladies and gentlemen, this is your crypto conspiracy report. Can you explain February the 24th in this security? ADA Cardano is not Ethereum. ADA Cardano is not Bitcoin. However, ADA Cardano is an altcoin. Is it possible that the monies are being funneled into certain securities simultaneously across the space? If that's true, to what ends? All right, flipping to the ETF space, this is the Bitcoin ETF BITO, BITO, on the New York Stock Exchange. And as you can see here, it is falling out of the Kumo cloud and is now falling over the cliff. But something weird has happened in this one. Can you spot the weirdness? Look at January the 24th. There's that date again. And up February the 24th. Now, these are not bearish pointers, not according to the definition of the term. But they came close to being it, didn't they? Still, the bars and the price action is the same. You have to ask yourself that question. I wonder why that is. And not only the why, but how. So accelerating to the downside, new down leg coming in BITO. Coin, as you know, Coinbase. Here's their stock. Well below the Kumo cloud, increasing selling pressure and hitting new weekly lows. Ouch. Going to take a lot to turn that tide. What about the Ethereum ETF from Grayscale? And this ticker is ETHE. And as you can see here, you got a primary crash alert. You got this nice downside production, and it's threatening to fall outside of the cloud. And again, January and February the 24th, respectively, same as the other ETF we just looked at. Here is the GBTC, the granddaddy of them all, the first Bitcoin ETF you could ever trade. Again, January and February 24th, bars the same. Downside momentum coming out of the cloud, looking to fall into free fall. All right, let's see here. Here's your theta. All right, once again, here is your January 24th, February 24th. So for these are different. This one gave you straight up black bars, while the other ones were mixing and matching. You had black here and blue here or whatever. But these are still bearish pointers nevertheless. And this bearish pointer in February took out the bearish pointer from January 24th. All right. And in theta, what did we do? We came into today with a primary rally alert. So this one is a divergence from the herd. You got your two bearish pointers here. This one was taken out because you hit that low of 227. Then on February, you had 227 again, 0.3. This one right here was 0.5. So this bearish pointer was the successful test / takeout of that pointer. You haven't seen this pattern happen yet. This is the first one that we see doing this, is your theta. So really watching the theta today to see if we will definitely see that upside production like that. That's nice. I can't deny that one. All right. XRP Ripple will be our last chart, and I think we can call it a day. Okay, XRP Ripple also doing something different, similar to theta. Here's your January the 24th, and here's your February the 24th. All right. And then here's your primary rally alert coming into today under the backdrop of increasing selling pressure. So, and this one still looks to be in the Kumo cloud. So I take that back. It's technically out of the cloud. Yep, it's out of the cloud. So you got XRP Ripple and theta, the two standouts that are doing something other than their counterparts, but nonetheless still had the same type of order flow on January and February the 24th, respectively. Same exact day to the month. That's a little creepy. I don't know about you guys, but that's a little bit too creepy for my taste. That's letting you know that it's all connected. Everything is connected. How does the saying go? Everything is everything. Yeah, I guess that pretty much holds true in these spaces. So we can't ignore what we have been seeing, because the markets tell you the truth. They tell you what's going on. They alert you to changes that may or may not be on the horizon. And you got to definitely look at those. You know, you can't ignore them. Not at all, not at all, not at all. All right. So as we speak, just let you see how the markets have fared. All right. Here's the real-time ticker again. So now we got green on the screen across the board. You got Bitcoin now up 1,310 points. All right, so it's off the low here. And you got the Ethereum Futures up 117. And you got your oil pulling back a little bit more. It's below 102. You got gold pulling back. It's only up $3.80. Silver's only up 14 cents now. Dow up 57, NASDAQ up 110, and Russell up 17. But your bonds are hanging in there on the positive side, 18-30 seconds. But soybeans, corn, and wheat are pulling back a bit. So that's kind of the way things are shaping up right now. And we'll see where we go from here, man. I mean, we live in some interesting times. I will say this, too, in closing. There is a situation with the holiday seasonal effects. Generally speaking, not always, but just generally speaking, okay? The markets do like to kind of end on a good note during the holidays. Certain holidays more than others. 4th of July, you can almost set your clock to it. The market is going to end on a good note. It's gonna rally. It's just, you know, it's just what the markets do. There's no rhyme or reason to it. It just is what it is. You know, and you just have to deal with it. But Good Friday, I'm not sure. Not really off the top of my head. I cannot recall what the bias is on that. I just know in general terms, markets do like to rally on the holiday. So if today being Wednesday, tomorrow's Thursday. So tomorrow's the last trading day for the week because the markets are closed for Good Friday. It's going to be very interesting to see what happens, you know, how the markets get back to doing what they do on Monday. So this could be the beginning of that rally into, into Good Friday. We'll see what happens, but that's kind of what it's looking like right now. It's kind of what it's looking like. We'll know more as the day goes on and when tomorrow comes into being. So just something to look at. It's what we're looking at. It's what we're watching to see as things develop. What's going to be what. All right, so there you have it. I've made up for last night. Told you I was going to hook you up. I did. Because I just ran out of time yesterday. I just could not get it on and popping with you. So now we've rectified that. All right. So with that being said, I will see you guys later on with the end of day report and the update on the trade journal. We'll see how these markets close and how they end and what's what. With that being said, remember, smash that like button. And remember, bulls make money, bears make money, and pigs get slaughtered. So remember to take whatever profits you can and give them back. I'm out. Peace.